Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Nazri Hakimi bin Jambi. I would like to present about company background of Dutchlady, Make Industry Berhad. Dutchlady was established in 1963 in Petaling Jaya, Selangor. For 60 years, we have embraced the changing lifestyle of our consumer and evolved to meet their nutritional needs better. Today, Dutchlady Make Industry is a 600-strong company that offers an extensive range of quality and delicious milk-based dairy products from formulated milk powder, yogurt drink, and many more. Dutchlady Milk Berhad already distribute nationwide to help Malaysians stay nourished and healthy to help them move forward in life.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nurasha binti Azman. My metro number is 2023452974. Today I will explain about justification for selection company, which is our company is Dutchlady. Okay, justification for selected company. First is industry fit. Businesses should be in the same industry or related fields that match the LMI Berhad's long-term goals. For example, if DLMI is centered on manufacturing or technology, it should seek partnerships or investment in those areas. Okay. Number two, expansion goals, which is if the LMI Berhad wants to grow into new areas or markets, partnering with companies that have strong networks, resources, and knowledge of the local market will be very helpful.
So next, I will explain about the core of product by Dutchlady Milk Industry Berhad. So Dutchlady Milk Industry Berhad does sell to customer or their purchaser, which is formulated milk powder for infants, children, and also adults, UHT milk, fresh milk, yogurt drink, cheese, and also flavored milk drink.
Assalamualaikum and welcome. Today we quickly explore financial ratios, an essential tool for evaluating a company's performance and financial health. Okay, financial ratios are numbers derived from a company financial document like the balance sheet, income statement, and cash flow statement. They give insight into profitability, liquidity, solvency, and efficiency. Now let's look at the main type of financial ratios. The first one is profitability ratios, liquidity ratios, solvency ratios, and last one is efficiency ratios. Profitability ratios show how well a company generate profit, like the net profit margin. Liquidity ratios, such as the current ratio, assess the ability to meet short-term obligation. Solvency ratios measure long-term financial stability, like the debt to equity ratios. And the last one is efficiency ratio, evaluate asset use, such as the inventory turnover ratio. And why are they important? These ratios help investors, creditors, and business owners make better decisions. They offer a clear picture of a company's strengths and weaknesses, guiding everything from investment choices to operational improvement. In short, financial ratios are key to understanding a company's health and performance.
Financial ratio analysis. First, liquidity ratio. Liquidity ratio are financial metric that assess a company's ability to meet its short-term obligation with its liquid asset. This ratio provides insight into a company's short-term financial health and its ability to cover immediate financial needs. They have three common liquidity ratio. First, net working capital. As you can see in the graph 1, we have 5 years of financial ratio that we are measure. Overall, while the company show period of strong liquidity, there were also time of liquidity concerns, which mean here, as you can see in the graph 1, they have increased and decreased over the year for the following 5 years. Next is current ratio for the LMI. As you can see in the graph 2, they have also increased and decreased. Overall, the company liquidity has a weakened over the year, with 2023 being the most critical, highlighting the needs for improved management of asset and liabilities. Next, we go to the quick ratio of the LMI. As you can see in the graph number 3, Dutchlady Milk Berhad has a quick ratio decline over the year. Overall, the company quick ratio has weakened over time, with 2023 marking the most critical period, emphasizing the growing reliance on inventory to meet short-term obligation.
Assalamualaikum warahmatullahi wabarakatuh. My name is Ahmad Afizuddin bin Hassan, number matric 2023455876. So basically, I will explain for the next part is financial ratio analysis. The main point is asset management ratio. So basically, asset management ratio are key to analyzing how effectively and efficiently small or large business manage its assets to generate revenue. So basically, wealth management metric are also known as a turnover metric or FNC ratio, some common asset management ratio, collection period for receivable on this day. So basically they have 6 main point that I will explain. Firstly is receivable turnover, average collection period, average payment period, inventory turnover, fixed asset turnover, and lastly total asset turnover. Alright, for the next part, I will explain about the analysis of receivable turnover ratio. So looking at the receivable turnover ratio, the data show a positive trend in the company ability to collect receivable efficiently in 2023. The ratio increased to 16.43 in 2023 compared to 12.87 in 2022, indicating that the company was able to collect its receivable more efficiently in the most recent year. This improvement in 2023 suggests a stronger focus on credit management and a quicker conversion of receivable into cash, which likely had a positive impact on liquidity. However, while the performance in 2023 is an improvement, it was slightly lower than the ratio observed in 2019, which stood at 16.14. This small decrease compared to 2019 highlight that the company was performing better in terms of receivable turnover to 2022. The dip in the 2023 may indicate slower in collection, possibly due to change in credit policies, economic condition, or challenges faced by customer. Overall, the improvement in 2023 suggests that the company has addressed these challenges and is making strides in improvement its receivable management, though further focus on optimizing collection call, bringing the ratio rate closer to or above 2019 level in future. Okay, for the next part is average collection period. So basically the data show the collection period has fluctuate over the years with a significant increase in 2023, which is in 22.21 days compared to previous years. The sharp rise in 2023 may suggest lower payment from customer. Conversely, the company managed to reduce the collection period from 2019 which is 22.61 days to 2022, which is 4.17 days, indicating improved collection efficiency before 2023. So lastly, I will explain about the average payment period for the data show the inventory turnover ratio declined from 2020 to 2023, indicating slower sales or restocking. Possible causes include reduced sales, outdated or excessive inventory, supply chain challenge, or difficulty adapting to customer demand.
Inventory turnover. The graph shows that the decline in the inventory turnover ratio from year 2020 until 2023, and it suggests less effective inventory management. This also may indicate or effect with the slower sales, outdated or excessive stock, supply chain challenges, or even difficulty adapting to the customer demand. Fixed asset turnover. Based on the graph bar, the fixed asset turnover decreased from year 2019 to 2023 and is dropping to 2.66 in 2023 compared to 8.26 in 2019 and also 5.23 in 2020. This suggests less effective utilization of fixed asset to generate the new revenue, and also possible causes of include underutilized asset and also inefficient production method, or even an increase in fixed asset without a proportional rise in sales. Total asset turnover. The total asset turnover decline from year 2020 to 2023 is reaching 1.42 in 2023 compared to 2.40 in 2019 and also 2.21 in 2020. This indicates less efficient use of total asset to generate revenue, and also possible causes of include asset inefficiency and may increase in unused asset or even asset growth without matching the sale increase.
Hi. Today we'll quickly review the leverage ratios of Dutchlady Milk Industries Berhad, focusing on how they manage debt and financial obligation. First, the debt ratio. Dutchlady's debt ratio dropped from 67% in 2019 to 54% in 2023, signaling improved financial stability. The rise in 2020 might be due to increased borrowing during the pandemic, but the steady decline since indicates a more cautious financing approach. Next, the debt-equity ratio. In 2020, the company had a high ratio, indicating higher risk but by 2021 it improved to 0.83, showing reduced financial risk. The ratio in 2022 and 2023 of 1.13 and 1.16 reflect a balanced approach to debt, supporting growth while managing risk. Finally, the time interest earned (TIE) ratio. In 2019 and 2020, Dutchlady had strong TIE ratios of 37.21 and 30.73, showing a solid ability to cover interest payments. The significant jump to 84.33 in 2021 indicates higher earnings and lower interest costs. Even though the ratio slightly decreased in 2022 and 2023, it remains above 14, signaling strong financial health. In summary, Dutchlady's leverage ratios show a trend of improved financial health, lower debt, reduced risk, and strong ability to cover interest payments. This positions the company well for future growth while maintaining financial stability.
Okay, I will explain about profitability ratio. What is profitability ratio? Profitability ratio is a financial matrix used to assess a company's ability to generate profits relative to its revenue, assets, equity, or other financial elements. These ratios provide insight into a company's efficiency and performance in terms of generating profits from its operation. Okay, from this graph, gross profit margin that I could define or I could search about in Dutchlady Berhad is the gross profit margin peaked at 37.94% in 2019, dropped during the pandemic, recovered slightly in 2021, then fell again in 2022. By 2023, it improved to 29.69%, but stayed below earlier heights, highlighting the need for better cost control. Okay, next I will explain about net profit margin. The net profit margin varied over the years, starting at 9.65% in 2019, dropping to 6.67% in 2020, and rising sharply to 21.88% in 2021, and then falling again to 3.56% in 2022. It improved slightly to 5.02% in 2023, but remains below earlier levels, showing a need for stronger strategies to maintain growth. And then operating profit margin. The operating profit margin peaked at 12.89% in 2019, dropped to 8.53% in 2020 due to the pandemic, and then recovered to 10.93% in 2021, and then fell again sharply to 3.87% in 2022. It improved slightly to 5.65% in 2023, but remains below 2019 levels, emphasizing the need for better cost management and efficiency. Okay, next is the return on assets, which is ROA. ROA in the graph below was showed in 2019 is 23.21, and then dropped to 12.23 in 2020 due to the pandemic, then surged to 32.10 in 2021, and then fell again sharply to 5.48 in 2022, but improved slightly to 7.65 in 2023. The trend shows the need for better asset efficiency to achieve stronger ROA levels. And then last but not least is return on equity. The return on equity ROE for 2019, 2020, 2021, 2022, and 2023 was 71.3, 44.04, 64.82, 11.66, and 16.56 respectively. ROE rose from 44.04 in 2020 to 64.82 in 2021, then sharply dropped to 11.66 in 2022. But it improved to 16.56 in 2023, indicating better use of equity to generate profits. Changes in ROE reflects a shift in profitability and financial health due to various factors.
Return in equity. Based on the graph bar, the return on equity from 2019, 2020, 2021, 2022, and also 2023 was 71.30, 44.04, 64.82, 11.66, and also 16.56, respectively. Return on equity from 44.04 in year 2020 to 64.82 in 2021. It's also dropped sharply to 11.66 in year 2022. It improved to 60.56 in year 2023 and also indicating better use of equity to generate profit in this company. Changes of return in equity reflect the shift in profitability and also financial health due to various factors.
For the conclusion is to wrap things up, Dutchlady has made some good progress in this year, like lowering its debt and boosting profit in 2023. However, to stay financially strong in the long run, the company needs to work on improving its cash flow and making better its asset. For investors, it is important to stay cautious and keep an eye on how the company handle cost control, liquidity, and how it manage its assets moving forward. This will be key in success in the future.